Hi, everybody. Welcome to this webinar, Real-Time Fraud Prevention in the Age of Faster Payments. I'm David Nesbitt, Content Marketing Manager at Incognia, and I'll be your host for today's session. So let's look at the topics we're going to cover today. So first, we'll talk about the landscape of faster payment rails. Then we'll look at the attack vectors FIs have to protect against with faster payments before we do a deep dive into how FIs are fighting these attack vectors today. So make sure you stick around to the end as well, because we're finishing by digging into what else FIs really need to be doing to prepare and fill gaps in their fraud prevention strategy for faster payments. And like I said earlier, we'll finish up with some Q&A. And so look forward to hearing the questions and thoughts that you have. Before we jump into our content, let's learn a little bit about our speakers today. So Andre, would you mind kicking us off by introducing yourself for the audience?
Hi everybody, I'm André Ferraz, CEO and co-founder at Incognia. Have been working with particularly geolocation technologies and device and security for over 10 years now. Excited to be here and to hear what Julie and Lenny have to share about real-time payments as well.
Great, and this is Julie Conroy. I'm the Chief Insights Officer at Datos Insights. Many of you may formerly know us as IT Novarica Group. I've been here for 13 years, and like all of the advisors here, we all come from industry. So prior to my time leading the advisory team here at Datos, I managed the product management function at Early Warning Services for many years, and prior to that, I was with a top 20 U.S. credit card issuer managing a bunch of their payment processes and risk controls. I'll turn it over to Lenny.
Hi, everybody. My name is Lenny Gusel. Been doing strategic advisory for a while now, both with banking and operator side, as well as with vendors to the fraud and financial crime industry. And prior to that, have held leadership roles running fraud and trust and safety teams to likes of Robinhood most recently. And before that, spent a number of years at Chase, building some of their platforms for fraud, identity, and authentication. And prior to that, Bank of America. Been in this space for, almost 20 years, and have was actually in the UK when the UK converted to faster payments circa 2008, and fascinated by all the things happening here in the United States, and following some of the similar parallels, and excited to be in this webinar with you guys.
Thanks so much, Lenny. So without further ado, obviously we have a lot of great expertise here on the session. So let's get started with our content. And Julie, could you start us off by sharing some context about the landscape of faster payment rails today?
Sure. So if we look at the next slide here, we've been talking faster payments now for going on just over 15 years. And the UK is so often is on the vanguard of things related to payments evolution, risk evolution that goes along with it. So they launched their first set of faster payment rails back in 2008. By 2021, fully 39% of all of UK payments were fully 39% of all B2B UK payments were going over faster payment rails. By the end of the first quarter of this year, we saw that 1.1 billion payments in the UK were faster payments, with that represented a 16% year-over-year growth. So there continues to be this expansion of awareness, this expansion of use cases, this expansion of recognition that faster payments has a ton of utility for consumers and businesses. But unfortunately, the flip side of that is it also has a ton of utility for fraudsters. We did a study earlier this year, and we're going to be sharing a lot of data as we go along, where we interviewed banks across a number of geos, and among them are the flags that you see on the screen: the UK, India, the US, Brazil. This by no means is the faster payments universe. There's now over 60 countries that have embraced faster payment rails. And as we'll talk about a little bit further along, as fraudsters have recognized the opportunity for fraud across faster payments, and as they have really honed their attack vectors and their tactics in early adopter markets like the UK, we're seeing that they're doing this rinse and repeat. across the geos and the banks and the consumers that subsequently adopt. India has seen great success with its faster payment rails. It launched the UPI in 2016. By Q1 of 2022, the UPI enabled 64% of all e-commerce payments, which I think that's just an amazing statistic in such a very short period of time, and 31% of the payment volume. The US, we've always got to do things a little bit differently here in the US. And so we don't have one, but we have two faster payment rails. Three if you count Zelle, but as most people on this call probably know, Zelle is really the consumer-facing brand, and the actual settlement behind the scenes happens either via ACH or via RTP. Zelle and RTP rails both launched in 2017, and this year we've seen the official July launch of FedNow, with well over 100 banks going live in July on the FedNow rails. As of 2022, we were seeing 2.3 billion Zelle payments a year. Same year, we saw 1.8 billion RTP payments, representing 12% of US volume. And then I think Pix is a super interesting story. And André is going to give us a lot of great color on Pix because he has a ton of expertise with those rails. They launched just in November of 2020. Within 1 year, so by November of 2021, Pix volume eclipsed card payment volume in the Brazilian market. 2022, they saw 29.2 billion transactions. One of the brilliant things that the operator of Pix, the Brazilian central bank, did was, November 2020, we were still in the middle of a pandemic, and they started issuing stimulus payments across the Pix rails to consumers to generate immediate adoption. They also created a mandate that any Brazilian bank with more than 500,000 accounts had to enable Pix. And so those are two factors in just the kind of rocket ship launch that we've seen of Pix adoption in Brazil. Anything to add to this, Lenny or André, before we move on to the next slide?
Maybe I could comment shortly here about the Pix experience, because it was right in the year that I was moving from Brazil to the US. So I moved in February of 2020 to start building Incognia. And it was interesting because what really changed when Pix was launched was not exactly the real-time aspect of it, because we were already used to almost real-time payments for a long time. Since I started banking, we had another system called TED that enabled payments that would settle in like 3 seconds. So it was near real time. But the difference here was that you had to pay, like converting to US dollars, it was about like $3 to $4 per transaction. So the adoption wasn't that high. And one of the big changes that Pix brought to the market was they eliminated all the fees. It became free to send money instantly from one bank to the other, and that exploded very quickly. So I think one of the aspects that made the adoption also move very quickly was the fact that people were already used to seeing payments settle almost in real time. So there wasn't a very significant change. It was basically the central bank coming to everybody and saying like, hey, now this is free, and people started using it for everything. I didn't use it when it was launched because I was here and I was stuck because of the pandemic. I couldn't travel. But I was shocked when I went back to Brazil to visit my family, and I went to the beach and people were like selling coconut water and saying, oh yeah, I'm not accepting cash anymore. Do you have a mobile phone so you can send me a Pix? And I was like, wow, this really changed very quickly. I only spent like a year out of this country and it has completely transformed.
That's fascinating. David, if we move on to the next slide. Yeah, as I mentioned, the US does everything a little bit differently. And the latest entrant to the faster payment rails is FedNow. And we're seeing, as you look at that 100 plus banks that were in that first tranche in July, it's financial institutions of all sizes. So it's, if you look down the list, and it's a public list on the Federal Reserve site, it's, small community banks and credit unions, regional banks, national banks. And so you've got this confluence of banks versus RTP, which that tends to be a little bit more concentrated at the larger banks in the US market. If we look at the next slide, David, we'll see that as you look at how fraudsters are capitalizing on the faster payments, faster fraud opportunity, which it's cliche, but it's true. There's two types of faster payment fraud, and it's really important to differentiate that, and we'll be doing that throughout this conversation, because you've got authorized payments fraud, which commonly known as scams, where the bank's genuine customer is socially engineered or duped into voluntarily sending money to the fraudster's account. You also have the unauthorized fraud, which typically manifests as account takeover. And the unauthorized is the fraud vector that we have been dealing with since digital banking began. It really became industrialized and a massive problem in the early 2010 decade. And I think one of the reasons why authorized payment fraud or scams are so problematic and so top of mind for financial institutions. This is among the top two questions that we get from our financial institution clients at Datos is, what are best practices in dealing with authorized payment fraud? Is because over the past 15 years, financial institutions have architected their digital channel fraud control framework around detecting that unauthorized activity and turning that on a 180 and determining what the intent behind your genuine consumer voluntarily sending money out of their own account is really, really hard. And Lenny, I know you were instrumental in developing a lot of especially the unauthorized control framework. So I'd love to hear your perspective.
Yeah, it's what's fascinating to me is there's, as we've seen kind of faster payment rails going across the world, there were certainly a lot of folks who predicted that there was going to be a rise in authorized payment fraud. And the simple reason for that prediction was that the weakest link in all of our control frameworks and all of our systems are the human beings. And we saw a fairly rapid rise from back in 2008 when the UK converted to faster payments as an entire country. We saw a fairly rapid rise, and in this kind of authorized payment fraud, where, as Julie, as you were saying, we had 20, almost 30 years across the globe to put in a lot of different controls and lots of different processes and policies, procedures, and so on for how we were going to dealing with people's accounts, online accounts, and then online credentials being taken over, and bad guys getting into our online banking accounts and sending money. But watching the actual response of fraudsters and how quickly they have taken advantage of faster payments using that weakest link, the human being, and effectively duping, tricking, scamming people into sending money in all kinds of ways, is amazing to see how fast it is. Now, just to get a sense of it, in the United States, again, we're still in the beginning stages of rolling out the actual real-time settlement, RTP and FedNow. But from the fraud perspective, Zelle has been a very enticing target, as have other P2P, P2P rails, but in the banking sector predominantly. We are at a point already where about half, if not more, of the banking payment fraud in the United States is authorized as opposed to kind of the ATO unauthorized. If you look at the UK, my sense is from conversations I've been having, it's at 80%. And what's even more fascinating is that even in the unauthorized category, a large portion of that unauthorized, i.e. a bad guy figures out how to get your password and whatever other credentials get into your account. The last leg of that is people being convinced or duped into giving away their their SMS codes or to sending the push notification on their mobile app. It is a kind of a form of the customer doing it themselves, even in the unauthorized space. And so what we're dealing with, Julie, to your point of how do you actually discern who are the good guys and who are the bad guys, and then how do we deal with this entire ecosystem of payments being sent across institutions into bad accounts, which we're going to talk about, I know, in the upcoming slides, and this entire ecosystem of fraud that has evolved, given the faster payments rails, is a real challenge.
It absolutely is. And then you add liability to the mix, which traditionally for unauthorized, that has been in most geos. North America is no exception. That has been the bank's liability. Authorized historically has been customer liability, but we're seeing that shift rapidly. And the UK, once again, on the forefront. October 2024, for most forms of authorized payment fraud, it will be shared liability between the sending and receiving bank. And all eyes are on the UK globally, and we're already seeing a number of jurisdictions contemplating following suit. Here in the US, there are a small subset of scam types, mostly bank impersonation types, with a set of circumstances where the bank now holds liability as of September of this year. And as we talk to Datos financial institution clients, they're already painfully starting to see that. If we go to the next slide, David. We'll see that as we talk about authorized payment fraud or scams, one of the other challenges to an already challenging attack vector is that not all scams are created equal. And so as you're kind of figuring out your detection strategies, as you're figuring out your talk-off strategies to actually convince your customer not to send this payment because they're being victimized, there's so many different types and they have different time frames. You've got your grandparent scam where your grandson is in jail and you need to send bail money and it has to be now, and there's a lot of urgency. And the one commonality with all of these scams is they're really tapping into and pulling emotional levers. And unfortunately, these scam rings are very good at doing this. The dating scam, the romance scam, they're going for the long game. It's kind of the other end of the spectrum from the grandparent scam, where it's a quick one, you're creating urgency. The dating scam, you're engaging somebody over weeks or months to suck them in. Oftentimes it has a crypto investment component to it. So it's often known as pig butchering when it's got that component. And as I talk to so many of our clients where they do detect some anomalous indicators, but then convincing this person that person that they're emotionally invested in is actually a scammer is incredibly challenging to do. So that's just adds to the further complexity of the scam ecosystem.
And if I can jump in here, what we need to understand is probably far and away the most difficult thing for financial institutions to deal with in this arena is, Julie, as you started saying, is what is the treatment? So we can assume that there is going to be various ways of detecting the possibility that a payment is at risk of some kind of a scam without even necessarily knowing what kind. But then coming to an actual targeted and specific approach for how to treat it and what to actually do. How do you, as you said, Julie, how do you actually have that customer understand that they're being manipulated and that they should not send that payment? Broadly speaking, I found it helpful for folks to think about it as short-term versus long-term. And that is very, very high level. And I think many financial institutions across the globe are starting to get very specific for understanding potential type of scam and how to then do the treatment. But the kind of the short-term being, it's a kind of imposter or grandparent scam or someone telling you that they're from the IRS or from the bank and putting you under immediate pressure to send something, as opposed to the long term where you've had months and months and months of someone convincing you that you are in a deep relationship of some kind, whether it's an investment type of relationship, friendship, or a romance scam. Those are significantly more difficult to have the customer recognize what's going on. And so broadly speaking, even just distinguishing between those two kind of long-term and short-term scams has been very, very helpful. But all of it gears towards how do we as an industry start to determine understanding not just intent, but understanding the background and the context of what is this payment about and why, and how to communicate with the user in a real-time scenario for trying to determine how to treat any particular payment at risk is possibly one of the most complicated things we need to do.
Absolutely.
Another thing I would add here is that one of the complexities is that these things are happening off the platform, right? So like they're communicating via text message, social media, phone calls. The financial institution doesn't have visibility into that, right? It only has visibility into like who's logging in, which device is logging into this account, and who is it sending money to, right? So it's very hard to monitor what's going on behind the scenes because it could be a legitimate payment, it could be a real relationship, but it's very hard to observe what's going on behind the scenes. So that adds to the complexity of fighting this.
Yeah, without question. And I love seeing in the UK market and Australia, as we're looking at some of the emerging kind of mechanisms that are being driven by the regulators in those countries, that the social media platforms and the telecoms are being pulled into the mix because they are absolutely an instrumental part of this ecosystem. If we move to the next slide, I know we've got a lot to get through and we're almost halfway through already. So as we look at some of the research that we've done at Datos on this front, from the study that we did earlier this year where we interviewed banks across US, UK, Canada, Brazil, and India, one of the questions we asked the financial institutions we spoke with was, as you look at the trend associated with various types of payment fraud, comparing 2022 attack vectors to those in 2021, as you can see from this data, those attack vectors leveraging real-time payment rails are rapidly increasing, and mule activity using real-time payment rails is absolutely leading the way. Up for the majority of institutions, 57%, up 57%, up more than 10% for 57% of the institutions. We're also seeing that consumer ATO using real-time payment rails is up for a huge chunk of institutions, 62%. And then as you look at things like the APP using real-time payments, again, up for more than half of the institutions that we surveyed. And so the faster payments, faster fraud adage really does hold true, unfortunately. As we go to the next slide, we'll see that scam risk is really what's keeping people up at night. So this actually is data that we haven't even published yet. This is one of the first groups that's going to be seeing this data. But as we ask financial institutions, thinking about your control framework and your financial institution's ability to adequately detect attacks and prevent losses, what two types of fraud are you most concerned about this year? And as you can see here, by a significant margin, it is those consumer scam attacks. And I think it's that perfect storm that we see where, fraudsters, the organized crime rings, they're doing the rinse and repeat. They have a very well-established set of attack vectors that they have tried and really honed in the UK market. They're expanding globally. Our control frameworks are nascent. They're really not yet designed to adequately detect or prevent. And then you add the third leg of the storm, which is the liability shifts that we're seeing springing up, or the threats of liability shift. And I think that is why this is something that keeps people up at night. Lenny, Andre, anything to add to that?
I'm going to add a fourth leg to the perfect storm, Julie, which is the operational complexity and cost associated with managing certainly in the area of liability shifting, but however much it shifts or doesn't shift, already there is such a huge operational overhead for how to deal with those customers' conversations, those treatments, both customers and fraudsters calling into the call center in order to deal with all of those alerts and cases and so forth. How to tag them, how to mark them, how to resolve them. It is a big part of of why everyone's up at night.
That is such a good point. And it's not just the customer facing operational aspect. As I've talked to a bunch of our financial institution clients, in the US market, in just the 2 months since we've had that liability shift for a very small subset of Zelle transactions, they said that the operational overhead of just figuring out who has liability has been massively painful. And so it's the internal just liability assignment stuff as well that is taking tons of cycles.
Yeah, and on that, I'll say that it probably kind of foreshadowing. I believe something that you have on slides coming up is that how are sending and receiving institutions collaborating and sharing data in this entire environment in order to figure that out, and in order to actually then process and go through a set of prescribed policies, procedures, and workflows for how they're actually going to do that. We're at the beginning of a couple of decades worth of making this work across our financial ecosystem.
Yeah, it's the collaboration piece. We'll speak to that in a little bit. That's where I think we've got enormous untapped opportunity, and we haven't even begun to scratch the surface there, unfortunately. David, if we move to the next slide, I think the other massive challenge with scams is we've got a consumer population that think that they will know a scam if they see it. And we've got a couple of bits of consumer data. The piece that we put in here was just around education. So a number of institutions, as we'll see in future slides, one of the things they're spending money on to combat scams is educating consumers. And I think you could say that virtually every financial institution in North America is doing something to educate their consumers about scams. It's statement stuffers, it's things on the mobile app, it is pop-ups on the website. I know from my institutions, I get actually some pretty good emails, but I pay attention to them because I'm in the space. As we survey consumers, when we ask consumers, has your financial institution ever tried to educate you about scams? As you can see from this chart, only 1 in 4 consumers think that their primary bank or credit union have tried to educate them about this, which shows the challenge associated with consumer education is just trying to figure out how you can get it to sink in. Once again, I think the UK is a poster child for doing some stuff right on this front. I just got back from London this morning, actually, and they have some really edgy and humor-laden education campaigns that they put on the telly, they put in the tubes to really kind of break through and get consumers' attention. I think in too many markets, we're still kind of seeing a white glove approach where you don't want to scare consumers, and it's very tentative, and that's where 1 in 4 consumers really have even registered seeing it at this point. The other bit of data from the same consumer survey was we asked consumers about, if somebody tried to scam you, would you know it if you saw it? And like 75 to 80% of consumers were very confident they'd know it. But then later in the survey, as we'd asked if they had ever fallen for a scam, over 1 in 3 had fallen for one. So it shows that cognitive dissonance there in the consumer base. David, if we move to the next slide. And the other thing that I think is a work in progress in so many geos right now is just the policy for reimbursing scam victims. This particular data set came from a survey that we did in late 2022, where we asked about a firm's policy for reimbursing consumer scam victims. And as you can see, there was quite a wide variety in terms of, firms that reimburse very little, firms that take a case-by-case approach, firms that are reimbursing a good chunk of things. And I think the 2 very interesting things about this data set for me were we asked a similar question in a study that we did just a year prior to this one. And at that time, at the end of 2021 in North America, very few firms, very few financial institutions were reimbursing for anything over 10 to 20% of consumer scams. And so you can see kind of the big jump we made in a year. And that was really when the Consumer Financial Protection Bureau in the US started making a lot of noise via guidelines, via public statements about, they were keeping an eye on this, potential liability shifts, and financial institutions started taking a second look at their policies. The other thing, though, is you look at kind of just the selective process, and you don't necessarily have a cookie cutter decision-making process to determine who gets reimbursed and who doesn't. That actually plays into some of the regulatory jeopardy right there, because if you're saying Lenny gets reimbursed, but André doesn't, why is that? Is that fair? Is that equitable? And so I think all of this is something that the ecosystems are grappling with, as we still have a lot of gray area in many geos about consumer reimbursement for scams.
And I'll say this is also one of the things that is feeding and fueling the rise in first-party fraud. Reimbursement means money, and the fraudsters are very clearly aware of that. And so I've heard estimates of the volume of reported reported scams, and how much they're rising. And don't quote me on these numbers, but it's 40, 50, 60, sometimes 80% in terms of an increase in volume in consumer reported fraud. The vast majority of that consumer reported scams, and again, the operational overhead of having to determine which of those are actually really good customers who have been scammed, and which of them are first-party fraudsters who are taking advantage of the liability shift and the entire reimbursement schemes that are being put in place.
Yeah, absolutely. I mean, when the UK saw its first contingent liability shift in 2019, where a good chunk of consumer scams got shifted to the FIs, as my team and I talked to the heads of fraud at those banks, they immediately saw a spike in first-party fraud. And over the past 18 months to 2 years, we've seen a number of US financial institutions publicly come out and say that they're going to start reimbursing bank impersonation scams. And overnight, they saw, not only increases in first-party fraud and bank impersonation scam claims, but you can also find the YouTube videos out there that are training people as to what to say and how to do it. So it's, the first-party fraud piece of this is one that will absolutely jump as the liability shifts take place as well. David, let's keep us moving. Time's a ticking here. So I'm going to turn it over to André to share some more great insights from PIX in Brazil.
Yeah, so here in this slide, basically, it reinforces this point that the liability shifts have been driving behavior on how the financial institutions are reacting and reinforcing their controls, right? So in this case here, for authorized attacks, right, what was interesting was that, and I saw that firsthand, was in the beginning, in case of an authorized attack, the sending financial institution was reimbursing consumers, not because they were forced to, but because there was so much pressure from consumers, because there was so much of that happening, that basically people started talking about these issues in social media, et cetera, and the banks started to reimburse them. What happened after was that the central bank published that they were going to change the policy and they would shift liability towards the receiving FI. And suddenly our team starts receiving calls, hey, how can you help me detect mule accounts, right? So it wasn't a problem, like it was a problem, but it wasn't something that they were prioritizing at the moment until the central bank published that new resolution for this update on the policy, right? So it's really interesting to see what's going on in different markets, because then you can predict where the FIs are going to prioritize their efforts in terms of building their stack, right? So for example, in this case, detecting mule accounts became the top priority when that shifted. And then on the next slide, for unauthorized attacks, actually, just one final comment on authorized attacks. Another thing that happened in Brazil was when Pix was launched, basically what happened was everybody's smartphone has become a wallet, but differently than the traditional concept we have for a wallet, right? There was basically all the funds that the person had access to were available on that device, right? So that device actually has become extremely valuable. And what started happening was street criminals started targeting people that were actively using their smartphones. So the phone was unlocked, and they were basically like riding a bike, stealing that phone, going to somewhere near, and basically making a Pix transaction, moving all the money that was available on that device, right? Why was that? Because, for example, many of the FIs in the beginning were relying on things like 2FA based on SMS, right? If you have the phone, to that same device, right? So they would be able to log into the account and then transfer the funds right there with that device. And everything looked fine because it was actually the same device that user always used, etc. So dealing with that was quite challenging. When the liability shifted and the receiving end became responsible, things started moving in the right direction, and people started investing in the right things. So in the next slide, when it comes to the unauthorized attacks, this one is more straightforward, right? In this case, the FI from the consumers, FI is reimbursing them. So pretty much the same process we've seen since this existed. And then on the next slide, I think we get back to you, Julie.
Yeah. So we'll start talking about some of the solution set from here on out. So not just the doom and gloom, but as we look at how institutions are fighting these vectors, we've seen mule detection investments rise significantly since the pandemic. And I think if you're going to find a silver lining in a pandemic, then this is one good silver lining, because we've been looking for a way to make a business case for mule detection for years. Typically it's been challenging because the party that is detecting the mule activity is not the bank that's taking the losses. It's the bank upstream, and it's the incoming bank that has the mules on its books. But with all of the stimulus fraud that we saw, with massive increases in the population of mules, the concern over regulatory activity, again, the training of would-be mules on things like YouTube, the active recruitment of mules. There's a couple of stats in the sidebar that I'm not going to read through. These are from a Lloyd's survey of UK consumers about just the extent to which consumers have at least no vocal acknowledgement of doing things like being asked to move money through your bank account in exchange for a cut of the proceeds is something bad. So this, all points to this ballooning mule problem that we're now actively doing something about. So we did a survey where we looked at the extent to which FIs are increasing their investment in mule detection. And the great news here is that we saw that 64% of those that we surveyed are doing so. If we look at the next survey, and I'm going to move through these pretty quickly just in the interest of time, because we've got a lot of great content and dwindling time. I think on the unauthorized payment detection side, even though it's a more mature attack vector, we still see that a number of institutions see a lot of room for improvement. As we asked about the confidence in their unauthorized or ATO control framework, only 43% of the FIs that we surveyed really felt like they had things in a pretty good shape. As we go to the next slide, we'll see that the good news is you look at real-time payments and the evolution of the control framework, we do see that active change is coming. So again, in the survey that we just closed out at the end of last month, as we asked institutions how likely they are to make major changes, not minor tweaks, to their real-time payment control framework in the next year or two, as you can see here, 2/3 of those institutions that we surveyed are likely to do so, which I think is just fantastic news. Going to the next slide, there's, especially in the ATO ecosystem where we've been fighting this battle at an industrialized scale for 15 years, the ATO ecosystem is much more mature than scams, but I do think that there's still considerable room for growth and evolution. As we asked about a whole variety of control factors that FIs are using, and I think you guys will all be able to get these slides after, so I'm not going to go through all of this eye chart. But if you look at just that bright green on the right side, those are controls that institutions, a good chunk of institutions don't even have deployed yet. So I think, the good news is even though there's still not 100% confidence among many FIs and their capability sets for ATO, there's a lot of tools at people's disposal that can help very effectively address it. David, if we go to the next slide here, I think the good news is authentication is getting a lot of focus as we look at those areas of transformation. So as we ask financial institutions about where they are prioritizing their bets in their spend, digital identity authentication controls are leading the way. And I will say this is a survey that we have done every year for the past 6 years. And authentication is in the top 2 every single year, which speaks to both the opportunities for improvement as we're looking at getting tired controls like KBA, which, fortunately that one's almost dead. But ubiquitous things like SMS OTP that are highly compromised, working those things out of the system and replacing them with things that not only are more effective from a security perspective, but also can provide a better customer experience, which really is the win-win. David or Andre, Lenny, anything to add to that before we dive into this slide?
I would say what strikes me, and it's been striking me for quite a bit, and Julie, it comes so clearly as you're and talking through the slides, is how we're at a point as a result of all the transformation with real-time payments, where every financial institution has to look at across so many different aspects of their domain and really get to a level of maturity and professionalism, not just in your account takeover, not only in your scams and kind of authorized fraud activity, not only in your mule account monitoring, but all of those together and across multiple touch points with their both consumers, small businesses, business banking. And so we're really at a point where the level of kind of maturation and kind of professionalizing of kind of where we've been plugging a number of holes, but with faster payments, every single financial institution is in a position where they really need to look at how do they holistically invest across these different attack vectors in a way that continues to provide a reasonable experience and manages their liability and losses at the same time. It's a lot of challenges all at once.
Yeah, and you and I were talking about this just earlier last week, and doing all that, and at the same time trying to provide a good and holistically uniform customer experience. It's a pretty tall order. It's not easy to do.
It's a tall order, and it's clear why authentication keeps popping up at the top, because it's as much a question of how do you continue to give people a reasonable experience in the digital as we've gone through digital transformation, and as things continue to become more and more digital and how consumers interact, how do you give them a reasonable experience, one that's consistent, one that's easy, one that's safe, and across all of these different channels. So whether you're trying to fight ATO or not, you're still going to continue to make investments across your authentication identity landscape.
Yep, absolutely. David, if we can move over, and that's a great segue into just the business case as to, as you are having to make the business case. And unfortunately, we still have to make business cases, whereas the bad guys just innovate. And that's why this continues to be that lopsided chess game where they're getting like 3 moves for every 1 we get at this point. When we ask financial institutions as they are driving change in their real-time payment rail control ecosystem, as they are making investments in their fraud control framework, what are the key elements of the business case? And I thought this was kind of interesting because we ask this question a lot as we're doing our various surveys of evolution of fraud controls here at Datos. Typically, as we ask this question, customer experience is almost always at the top and usually closely followed by fraud losses. And it's only 10 points behind in this one, but I did think it was interesting that we're feeling enough pain, both on the authorized and the unauthorized side of faster payment rails, that as you ask executives about what is their primary driver of these business cases, right now it is those fraud losses that has that top slot. André, I know you talked to a lot of financial institutions, a lot of neobanks, cryptos. Are you hearing something similar on this front?
Absolutely, yeah. If we observe like the sales cycle, depending on the business case, it is completely different, right? So our solution addresses both the client experience, so it helps our customers like provide a frictionless authentication experience, etc. But it also helps reduce fraud losses. And when the problem is fraud loss, the sales cycle on our end tends to be at least half the time when compared to client experience, right? Why is that? Well, basically the FI is losing money, and more than that, they're seeing the problem scaling, right? Because if they don't fix it quickly, they become a bigger target. Fraudsters collaborate a lot, right? So they communicate, hey, that FI has this vulnerability, let's attack them. So if they don't fix it quickly, it could become a much bigger problem. So for sure, we see that when fraud losses is the primary driver for the business case on adopting a new technology, it becomes a top priority more quickly.
Absolutely. I know we've got some questions coming in. I want to make sure we leave time for this. Let's move on to the next slide here. So we at Datos run a impact award every year where we invite solution providers to submit kind of the new innovations they've released over the last couple of years. We require that they be in production, that they have metrics that demonstrate the effectiveness of the solution, both from a detection as well as a performance, as well as from a client experience perspective. And literally, we get multiple dozens of submissions to this. The judging panel it's truly an industry award. So we've got a couple of judges internal to Datos that are on this, but we recruit a number of financial institution executives. They outnumber us 3-1 on the judging panel. And I'm pleased to say that Incognia got our winner of Best Digital Identity Verification Innovation this year. As you look at some of the judges' comments as to why they were selected this among the many submissions we got, it really was some of the client testimonials that we got. This is a direct quote from one of the clients about the ability of the Incognia solution to lower false positives, reduce identity fraud, specific to, in this case, it was a new account creation as well as an ATO use case. And it was the ability to do this with, without invoking PII and having to go through some of those hurdles in the business case process. And at the same time being pretty much passive and behind the scenes from a customer experience perspective. So congratulations to Incognia. And André, I don't know if you want to add anything before we jump into some of our key takeaways and then open it up for questions.
Thank you. Just like thanks for that. Really excited to see the recognition. And I'd say the approach we decided to take here was actually very simple. We got back to the first principles and tried to understand like what is common among multiple online interactions we have, and we realized that there were basically two things in common for all of those, which was for every online interaction, you will, and it doesn't matter the platform. It doesn't matter if we are like in a metaverse or on a mobile channel or on a browser, on a desktop. We will always do that from a device and from a physical location. So we decided to go very deep on understanding these two things, understanding which device is this and where is it. And by doing that really well, we found that we could create a more, let's say, universal solution for identity verification that would work across platforms and would fill some of the gaps that we have identified in the space, particularly when it comes to device fingerprinting. We noticed that fraudsters have developed many techniques to evade detection using device fingerprinting. So we added this additional layer to fill those gaps. But very, very happy for the recognition.
Absolutely. Well deserved. And if anybody on the webinar wants to see the full write-up of the Incognia Award and why they got it and the use cases, you can reach out to the Incognia team and they'll be happy to provide you with a copy. So David, let's jump into our key takeaways here. And the scam problem is going to get worse before it gets better. Unfortunately, we're still kind of on the climb. We are definitely not even close to the downhill yet from a solutioning perspective. The good news I do see though is that with the monetary incentive that some of these liability shifts are taking, I think we're seeing the solution ecosystem accelerate probably faster than what we saw in the early 2010s as ATO became industrialized. And we saw substantial motivation for FIs to spend there. I think we are seeing a number of really interesting solutions come to market that can help with these challenges on real-time payment rails. Mule detection, I think that's the place where, from an authorized payment fraud perspective, that's where the low-hanging fruit lies, because it's easier to detect the anomalous behavior associated with a mule account than it is to try to figure out the intent behind your genuine customer sending an outbound payment. And so that's where I think a lot of the solutioning we're seeing is today seeing success. And I think that's going to be some of our low-hanging fruit from taking a bite out of this problem. One of my colleagues has very aptly called it the scam apocalypse. And I think better mule detection is our way to really prevent it from achieving that scam apocalypse status. And Lenny pointed it out earlier, collaboration, both within FIs, across FIs, with the social media, the telecoms, that's going to be another key opportunity for us to get ahead of that curve. Turn it over to Lenny and Andre. And then I think, Andre, we've got one more slide and we're getting close. So maybe, David, we just respond to questions by email after the fact.
Sounds great.
I'll just respond to one of the questions as part of the kind of reaction to the slide. And there's a question in here around machine learning models and their effectiveness across these attack vectors. One of the things that I'm seeing a lot of financial institutions really focus on in investment right now is how do they get much more facility with building their own. So both building their own as well as acquiring machine learning models and having the kind of the technology stack that allows them to rapidly be able to deploy different types of machine learning models to address these problems. So specific models for mule detection, specific models for the sending side, specific models for the receiving side, and the collaboration thereof. So I think they are absolutely a huge part of the equation, and I think a lot of investments from my perspective are being made in how do I get kind of facility with being able to rapidly, or as rapidly as I can, both be able to deploy them and take advantage of them and different kinds of models across all three problems that are on this side.
Yeah, and to add to that on the machine learning front, like I'd say having high quality data is the most important thing here, because if you don't have high quality data, it doesn't matter how good your ML model is, it won't perform. And in some cases, if you have access to very high quality data that you know it's not tempered, and provides like good granularity in terms of understanding who's that person, sometimes when you have, again, very high quality data, rules sometimes perform better than machine learning models. So it all depends on the data. I would prioritize having access to the best data that you can, and testing different models, testing rules as well. It's not one or the other. In many cases, you use a combination of rules and ML. Sometimes rules for the most straightforward cases, ML for like the gray zone. But again, the top priority here should be the data.
Great. And next slide, David, and 1 minute, Andre, for you to bring us home here.
All right. Well, so one quick comment here on how location can help. One of the things we've seen in markets where real-time payments has become widespread was the growth of the use of location as a signal for fraud prevention. For example, last year we saw even Apple Pay starting to enforce the use of location for every user for fraud prevention purposes. And the same has been happening in other countries. For example, Mexico has recently passed a law in which every FI has to collect location from their users, etc. And wanted to comment here about some of the use cases, right? So first of all, location can help you bind the device to the identity on a continuous fashion. So what's interesting about this is you can use that to detect new accounts very effectively, right? So if one account was created, everything looks good, but suddenly the address associated with that account no longer matches the behavior of the device that is accessing that account, it is most likely to be a new account, right? Either the user has moved and didn't notify the FI, or that's a new account. Second thing, which is interesting, is that we see in our network that over 95% of the real-time transactions occur from places where the user goes very frequently, like your home, your office, etc. So understanding that can help you both provide a frictionless experience to the good users, but also detect suspicious activity more effectively with real-time information, right? So basically, those are just two examples here of how location has been used by FIs, and I believe that's probably going to be one of the new areas of investment for the FIs as we move into this space.